we're going to focus on Proposition 19 that is currently on the state ballot. So officially as assessor and also the organization, we do not take a position on the ballot measures that would have where we would administer them. We want to make sure that we're providing impartial, neutral information to you so that you're able to educate property owners and others about what's coming down the line. However, it really is important that we do get good information out there so people understand what's happening. I'm going to share with you a little bit. I think some of the slides that we've created will help to explain what Proposition 19 would do, but in a nutshell, it does change two major areas. It changes transfers, being able to keep a Prop 13 value for transfers for seniors who are trying to replace their properties, and also it would impact parent-to-child transfers essentially, or family transfers. Currently, there's ability for families to be able to transfer some properties, especially primary residences, and up to $1 million of anything else to their children without a reassessment to market value. This potentially would change that. And so it's important to just know at a high level that it impacts two different pieces. And so I'm going to start sharing my screen with you. So just give me one moment while I do that. Can you all see that?
Yes,
Yep.
Carmen, I can see.
Okay,
Yes.
Thank you. So again, as I mentioned, today we're going to be focusing on Proposition 19. It is called the Family Home Protection and Fairness in Property Tax Reassessment Act. That's what it's called on the ballot. It primarily impacts two different existing pieces of law. One is Propositions 60 and 90, and then Propositions 58 and 193. And so as I mentioned again, it deals with the senior transfers as well as, or senior base year transfers, as well as parent-to-child transfers. So those are all related to those pieces. Just to make sure that we all start from the same place of understanding, under current Proposition 13 that was passed in 1978, what we typically do if you follow these two lines is that, let's just say in 2015, you purchased your home or property for $500,000. That would set what is called your base year value for your property. We would be able to increase your assessed value, so what we use to tax you, only by 2%, or the California CPI, whatever is lower, in every subsequent year that you remain the owner of that property. So if you see the red line below, under Prop 13, every year, so you see there, we would only increase it by 2% at the very most. And so there you see, first year, you're assessed at $500,000. The next year we add the 2%, so it becomes $510,000. The year after that, it's another 2% on top of that. So your assessed value is $520, $200. That's only under Proposition 13. Even if what you see happening in the marketplace is something dramatically different. So you see the blue line above, that is potentially one example of a market where you see the inflation value of homes going faster than, for example, the inflation factor that's allowed under Prop 13. So even if I first bought it at $500,000, the next year, because it's a improving market, all of a sudden my assessed value of my home, or my market value of my home, is $600,000. We would still tax you at the lower Prop 13 allowable value of $510,000. Similarly, even if your home increases in value over time to $1.6 million from back in that time frame, we would still only be assessing you as what is allowable under Prop 13, which includes, again, just that 2% factor. So you can see that over time, especially if you've seen significant appreciation in property values over time, whether it's for single family homes or commercial properties, essentially the value or the impact of having a Prop 13 reduced base year value is pretty significant for taxpayers over time. And so what does this proposition do? So a few things. It would change senior assessment transfers. So if you currently are a senior and you want to purchase a replacement property, under certain circumstances, you're able to maintain that lower Prop 13 value for your new property. Here's the way that it currently works. If you, and you'll see that on the left side of this slide here. Some of the conditions are you have to be 55 years of age or older. you could only partake in this benefit one time. It has to be a county that's participating. So in San Francisco, for example, if you buy a replacement property in San Francisco, we do allow for that base year to happen. However, we do not in San Francisco allow for a transfer from another county. So if someone from San Diego County wanted to buy a home, a replacement property in San Francisco and bring with them their Prop 13 value from San Diego, San Francisco would not allow that to happen. There are a handful of counties that do allow for the inter-county transfer. I think it's probably around 11 or so counties that currently do it, but San Francisco is not one of them. And the other condition is that you would have to purchase a property that is equal or lesser in the current market value of the home that you are replacing or your existing home. Under Prop 19, a few major changes happen. There is no longer that restriction in terms of equal or lesser current market value for property. So you could potentially purchase a replacement property that is higher in market value than your existing home and still benefit from this program. However, there is a discrepancy in you would have to have an added value on top of your existing Prop 13 value. Number two, remember how I mentioned that San Francisco only allows for within county transfers and we don't accept from other places. What this proposal would do is that it would just across the board say that every single county participates in inter-county transfers. So if this passes statewide, San Francisco would be forced to essentially take any county's valuation. For the most part in San Francisco, that's not going to be as big of an issue because we are a high value county. So unless people are really interested in purchasing a higher valued property, we won't see that kind of impact. Typically, it's the other way around. But that being said, it would just make it automatic. That doesn't matter where you're originating within the state, you can transfer it to any other place that you're purchasing that replacement property. Rather than it being a one-time benefit, they are now increasing it to a 3 times benefit. And in addition to being 55 years of age or older, they've added additional people who can participate, including folks who are severely disabled or victims of natural disaster or contaminated property. And so that's something that is different. So how would the program work? So if you take a look at this, I share with you kind of what your old home is and what your new replacement home would be in a scenario like this. Say, for example, that your old home assessed value, so your taxable Prop 13 value is $300,000, but you sold that property for $1 million because, of course, we've seen potentially appreciation in property over time. If you purchase your new home and you buy that new home for $1.5 million, the way that you would now be taxed is essentially taking your $300,000 kind of base year value that you're transferring over and adding on top of that differential. So the 1.5 million, what you purchased, minus $1 million, that will be $500,000, and you add it to your existing assessed value. So that's the way the senior assessment transfer works. They call this measure the Realtor's measure because part of it is that I think it helps the impact of this would generate more sales potentially. So they're trying to encourage the sale of property here. The second piece of the proposed change impacts Proposition 58 and 193. This is actually a very important one to mention because we hear a lot of questions from the community about this question. In particular, when we've had family wealth forums and we've had different community meetings, people ask a lot about transfers from parents to children and whether or not they're eligible to keep the low Prop 13 values typically from a taxation perspective. So here's on the left-hand side, again, is going to share with you kind of what the current scenario is and then what the new proposal will do. So under the current scenario, you can transfer, if it is a parent to child transfer, you can transfer your principal residence, so where you're currently living, to an eligible child. And it's both ways. So it could go from a parent to child or child to parent currently, right? There's no residency requirement. So even if I pass it on to my child and he or she doesn't live there, they still get to benefit from this exclusion from a reassessment of market value. And there's also no limit. So whether that principal residence is worth in the market value $1 million or $20 million, there's no limit. I can pass on that Prop 13 lower value to my child who's eligible, regardless of whether they live there and regardless of what the value of that property is. That's the current law. In addition to that, you can also pass on about $1 million. There's a $1 million cap on assessed value of any other property. So aside from a principal residence, if you have a second home or if you have commercial property, etc., you can pass on the Prop 13 value, the lower assessed value of up to $1 million cumulatively onto eligible beneficiaries. So the way that the new proposition would impact that is a few ways. For the principal residence component, the person who is receiving it does have to have that also be their principal residence. So if I pass it on to, let's just say, my daughter, but my daughter chooses not to live in that home, she would not be eligible to keep that lower Prop 13 value. That's number one, a big change there. The second piece is that there is also a limit to the amount of assessed value that you're able to transfer over to that property. So remember when I mentioned earlier that for the principal residence, it doesn't matter if your home is worth $1 million or $20 million, it passes on as is, or it can keep that Prop 13 value. In this case, there is a limit to the amount that you're able to pass on for benefits. So it's not only a residency requirement for the person who's receiving the property, but they also potentially won't have full benefits, especially if you are in a high value place like San Francisco, because we have many, many homes that are worth a lot of money. The other piece is that there is no other provision for additional property, so it really is just restricted to the primary residence. Clearly, if you have a second home or if you have commercial property, the beneficiary, the person who's receiving it, isn't living in that space. And so how does the calculation work in this situation? So let's just say that you have your home, your existing home is $500,000 from an assessed perspective. So your Prop 13 lower value is $500,000, but the market value of my home has now appreciated to 1.6 million. Now I want to pass this on to my child, for example. What would happen at that point? Well, the first step in this new proposal is that you would take that $1.6 million, you would subtract $1 million. So this is a formula that is included in the legislation, and you get $600,000 remaining, right? You would compare that $600,000 to the $500,000 of your assessed value, and whichever number is higher will be your ongoing assessment. So in this case, if I'm comparing the $500,000 in assessed value versus that $600,000 after the calculation, clearly the $600,000 is higher, and that will now become the assessed value of the property, even if my child does decide to live in that home that they're inheriting. So that's a pretty significant change from the current law as is. So I'll stop sharing my screen from here, but really in a nutshell, those are kind of that is the big change associated with the new Proposition 19 item. And so I'm happy to take any questions that